This is Pitambaran. Good morning, all. This is Pitambaran Nachutan Pishayadi from PDM Advisors Private Limited. Today, I would like to share a simple strategy where you can trade any stock that you like from Nifty 50, preferably because Nifty 50 stocks are stable. So, what you can do is that you can suppose you are planning to invest 5 lakh rupees in one stock. So, you can see here the capital to be deployed, I have said as 5 lakhs, and I will buy 50% of that capital at one go. Now, suppose the current price is 150 for a script A. I'm not specifying a script. I'm just giving you an idea how to plan your trade. So suppose the script price is 150. So you have to divide 2.5 lakhs by 150. So the number of shares to be bought is 1. You're getting that formula 1666.67. I'm rounding out to 1670 so that I can divide this in 10 steps. So if I divide it by 10, I'm getting 167 shares per trade. Now what I'm going to do is that once the shares comes into my DP, I am planning to sell these shares 10% each time it goes up by 10 rupees. That is why I've written difference between each sell 10 rupees. So the moment it goes to 160.75, I will sell 10% of 1670, which is 167 shares, and I will release 26,845 rupees value. Now, if the share falls, I am planning to buy it back at 145.75, which is 15 rupees from my sell price. So what happens here is that every trade gives me a profit. If you see the chart of any particular stock, it will not be in a linear motion. There will be many ups and downs. Now, I want to catch all the ups and downs by focusing on only one stock rather than dividing my capital into 10 stocks. So, whatever is my trade capital, I've given this example 5 lakhs just for an example. You can start with any number of capital in whatever capital that you want. But the problem here is that if you start with a small capital, the return per trade will be very small, very negligible, and you will not see that you're getting good returns. But you will be getting the returns in terms of percentage. Okay. Now, what I have decided that I will be selling at every 10 rupees, which is equivalent to 6.67% on the up or 6.67% on the down move. So as the market goes up, I will keep on selling. And from wherever it reverses, if it comes to my sell target, I will keep on booking my profit. Now, I'm not sure whether the market is going to go up or go down if after I enter my first trade. So that is why I've kept this 2.5 lakhs free to buy shares if that stock falls. Now, the same principle I'm using it whenever it falls by 10 rupees, I will buy shares. But since I'm buying at a lower price, the quantity that I can buy with the same capital is more. Here I bought 167 shares, but if the market falls, I can buy 260 shares. The principle is same that I am buying at every 10 rupees fall and I am booking my profit at every 35 rupees rise. So suppose after buying 140, it went to 130, 120, and then it bounced back. Then as it goes to 155, you will book your profit from of the stocks that you have bought at 120, and you will be getting 9,100 rupees profit. Since you are keeping a higher target and the higher quantity, your profit in the buy will be more as compared to the profit in the sell. So this is the way that you have to make a trade plan. And suppose if the market goes in one direction also, there are certain scripts that go in one direction also. Suppose it goes in one direction and doesn't come down, then also you will be exiting with 55 rupees profit, as your sell average will be 205 and you have bought at 150. So you're getting 55 rupees profit, which is equivalent to 37.17%, which is a decent return if you take into consideration the return that we get normally in Nifty of 14% per annum. So there is every possibility that you will get multiple trades here. And suppose if you're able to make 1 lakh rupees in one particular calendar year, that means you are making 20% return with the shares that but whichever shares that you're holding will be in profit also. So overall, you will get a very good return in this particular trade. The thing that you have to do is whatever profit you are getting, you reinvest that profit into the same shares so that you can gradually keep on increasing your quantity, and then you can vice versa change the number of shares that you are selling or buying. So by even trading one script, whichever you like, but preferably select Nifty 50, because the variation that comes in Nifty 50 stock is limited rather than comparing the other stocks. Your returns will be limited to say 15 to 20% if it remains in a narrow range, and 30% if it moves in one direction. But this return is also very good if you compare the risk that you are going to take in trading other stocks which are highly volatile and has every probability of going down also. So preferably select Nifty 50 stocks and trade in this manner in one stock also to generate an income of 15 to 20% per annum if the market is not volatile, and about 20% if the market is volatile. I hope you have understood this strategy. You will do your own calculations and then try for it for a few days on paper trade, and then when you are convinced with the strategy, you can go for real trade. You can use automation also to use this strategy to trade this strategy, wherein you just fill in the Excel in one time and the rest is taken care by the system. So algo can help you to trade this type of strategies and get good returns. I hope you liked watching this video. Thank you for watching.